Um, Hello. Sorry about that. This presentation discusses some market value ratios. Again, they're financial ratios. This is the one exception where we are using ratios that include market value. All the other ratios we discuss are book value only. So you do have to go out and find out what the market value of these are. And the purpose is specifically to measure how the market value of the investments relate to accounting values. We're going to talk about three of them: the market to book value, price to earnings ratio, and enterprise value over EBITDA. All of those are fairly commonly used. And again, they're really there to give you some sense of how the market views the future prospects of the firm. So first is market to book, pretty simple. It's the market value of equity over the book value of equity. You can either do that on a per share basis, which would mean the stock price, and then you'd have to take the book value of equity and divide it by the number of shares. Or you can do it on a total amount, so take total market capitalization divided by the total book value. And kind of the way to think about this one is that book value is really a reflection of the money that the company received when it sold stock, plus basically the retained earnings, so that have come in from income over time, and then less any distribution back to the stockholders. So it really reflects what we've gotten so far and from equity and what we've done so far with it. Whereas the market value tends to be very much forward looking, thinking about what's going to happen in the future, what good projects are coming down the pipe, and all that sort of stuff. And so when you do this ratio, you're sort of asking the question, how much higher are the future prospects, or the value of the future prospects of the firm, than just what's sitting in the equity account right now. And so generally speaking, while this is a percent, you hope that it's higher than a 100%, and in fact can be quite high. Obviously, if it's lower than 100%, that's a real problem, because that says that the market won't even pay for your stock an amount that's equal to what you have in the equity account right now. And so that's like saying that they basically expect that you're going to be destroying value in the future. Low ratios, and it's hard to know again what a low ratio is. Those indicate that the firm maybe has limited growth opportunities or is considered very risky, and so at that point, the company maybe is better off by giving the equity back to the investors through the form of dividends, for example. But really the bottom line on this, and this is true with all the market value ratios, they're a bit different than the other ratios that we've talked about in terms of comparability and so forth, because they do absolutely speak at the investor level to whether this is a good investment or not. And so in some senses, you can compare those across industries because investors kind of want the same thing. That said, these will be driven a lot by the riskiness of the firm. And so, if I have a high risk firm, then I would expect the market values to be low. Low risk firm, market value to book might be high. So sometimes the percentages are an indication of how risky you might think the firm is. But if you have two firms, even if they're in completely different industries, but you consider them to be of similar risk, and they have very different market to book value or any of these market ratios, then you need to do some digging, because that speaks something else other than risk. It may speak to opportunity. Second ratio is the price to earnings ratio, or PE ratio. Very commonly used ratio, very commonly mentioned ratio in finance. Price is simply the price of a share of stock. Earnings are earnings per share, so you would take your net income number off your income statement, and you would divide it by however many shares of stock you have outstanding to get the net income per share, earnings per share. The value should ideally be greater than 1 on average. I say on average, there are times where a company will have negative earnings, and clearly when one of these two numbers is negative and stock price can't go negative, it's going to be a negative number, so not greater than 1. But you just have to be careful that you sort of don't only look at this on a monthly or a quarterly or a one bad year basis. You want to look at a trend over time, and when you look at that, you should expect to see something greater than 1. At 1, less than 1 on a consistent basis basically suggests that the market does not see much growth prospects. So it's a very similar kind of notion to the market to book in that sense. It should be higher for firms that have low risk, the ratio should be, and lower for firms that have high risk. It should be higher if you have higher growth opportunities in the future. Generally speaking, investors prefer higher values. You can make the argument that says the reason the share price is so high is because they like the stock so much, they're willing to pay more for it. And so that's kind of a way of thinking about that. And the implications here are, look, if you increase the growth opportunities or reduce the cost to capital or both, that you can improve this. You can potentially improve this by reducing the number of shares outstanding as well. I guess you can see that. I guess that's not true. If you did that, your earnings would go up. So generally speaking, kind of go this approach to it. Last ratio we're going to talk about is the enterprise value ratio, or the enterprise value to EBITDA ratio. We just call it the enterprise value ratio or EV ratio most of the time. Enterprise value is the market value of your equity, so stock price times shares outstanding, plus the market value of your debt. So if you went out and looked at all your debt issues and saw what your debt was selling for today and summed all that up, that'd be the market value of debt. A lot harder number to get hold of if you're just looking it up, but like Yahoo Finance and other places, a lot of the time will give you a full enterprise value. They may not break it into the two pieces, but otherwise kind of hard. Easy to get market value of debt, harder to find market value or of equity, harder to find market value of debt. And then what's it divided by? Most commonly EBITDA. So earnings before interest, tax, depreciation, allowance. Since the interest, tax, depreciation, all that sort of stuff, I don't know what happened there, sorry. Since the interest, tax, all of that sort of stuff is part of the cost of this equity and debt, a lot of times gets left out. But sometimes people just do the EBIT or the EBIT that way, and so the depreciation allowance gets added back in. What's the relevance? Well, again, there's sort of a similar perspective between this and the price earnings ratio. It's really talking about market value to earnings. The big difference is that this one includes both debt and equity market value. And so if I have firms that, maybe they're similar industries and all that, but they have different amounts of debt to equity, so different financial leverage, then you really can't compare the PE ratios across them well. I mean, you can, but it's skewed by this leverage, whereas this enterprise value to EBITDA measure you can compare irrespective of that. So what a lot of people will do, for example, is they'll calculate both, and what they're looking for is something that says, if the enterprise value ratios are the same or sort of in a similar range and the PE ratios aren't, that's probably because of leverage. Let's go check that out, right? Whereas if the PE ratios are the same, but the enterprise value ratios are quite different, then you would look at that and say, well, maybe we shouldn't be comparing the PE ratios or thinking of them as being the same. So a lot of times those two are done simultaneously, just as a way of making sure that we're looking at this both ways. Ultimately, most of the time, it's equity owners that really care about understanding these market value ratios. And so they're really most concerned with the PE ratio. they use this one as sort of a check just to make sure that there isn't some leverage thing going on there. Obviously, a little bit different management implications here. I can increase the market value by increasing growth, decreasing risk. I can obviously change the values a little bit by shifting from debt to equity, so changing my leverage a little bit. Not a whole lot, but that's kind of the argument there. If I decrease risk, I should decrease I should improve the value of my debt and improve the value of my equity, and so both of those would make things go up. If I increase growth, and so just new growth opportunities that will help the market value of equity, won't help the market value of debt so much, so maybe not such a big of a benefit. That's really all there is on these market value ratios. Again, the key thing to remember here is, of all the ratios we've talked about, these are the only ones where you actually have to go out and get market value. Thanks.